Hello and welcome to part 3 of IRS Trust Fund Recovery Penalty. If you have any questions, you can call me, Ralph, at 941-723-9106. You can also find more information about these topics on my website, taxuless.com. In the next videos, I'm going to explain how to settle your tax debt with the IRS. There are 4 primary ways that are procedurally available for you to do this. There are 4 methods that you can use to settle your debt with the IRS: uncollectible status, partial pay installment agreements, and offers in compromise. The first method that can be used to resolve your tax issues for unpaid tax debt that I want to talk about is uncollectible status. If your prospects for paying your taxes are not good, for example, if your income, and it's helpful to think of this as your monthly income, because if you think of an annual, they think of it as monthly. It's something that people can wrap their head around and understand, and that's the way the process is built. So if you think of, if your monthly income is just enough or maybe not enough to pay your living expenses, then you probably qualify for uncollectible status. Now, living expenses are the cost of maintaining your home, for example, rent, mortgages, electricity. They allow something for a telephone, then they allow for food, they allow something for transportation, health insurance. There's just a list of things, and these standards do vary by geographically, because different areas have higher cost of living. They don't allow a lot, and it's not totally clear-cut. Some categories are easier or more clear-cut than others, but for example, if you're living in a home that you own and the house is underwater, by underwater I mean the house that what you owe on the house is more than what you could sell it for, then you're stuck with the mortgage. Then the IRS will work with you on that usually, but the living standard for how much they allow for rent and mortgage payments might be less than how much you're actually having to pay. So it's not totally paint by the numbers. There is some negotiating, and they allow time sometimes for you to clear some things up. But once you get into uncollectible status, IRS will stop all collection activity. So that means they're going to stop threatening letters, they're going to stop levying your bank account, levying people who might be paying you, and they will file liens in most cases, and if they've already filed liens, the liens will generally stay on. Now, I have had them lifted for certain particular cases, but almost always they're going to leave the liens on there. That protects their interest in your property. If for example, if you sold your house and there was any money coming out of that at closing, in terms of the equity payment, they would be expecting a check from the closing of that for that amount of money. So that's what the liens do. They protect the government's interest, and they're pretty tough about keeping those on. Generally, you will not hear from the IRS for 6 months, a year, or longer. It depends. So you can stay in uncollectible status for a long time. So even though, but here's the thing: even though the IRS stops harassing you with letters, and the penalties and interest are still accruing. So that's one of the disadvantages of staying in uncollectible status, because the tax bill, it just keeps growing. The IRS doesn't grant uncollectible status easily. You have to submit forms that detail your financial information, and the details have to be supported with good, adequate documentation. So it's a little bit of a process, but it does work. You're being placed, so generally you're being placed in uncollectible status. It does not permanently resolve your tax problems, and that's in most cases, but it can. For example, if you stay in uncollectible status long enough, your statutes will run, and that can happen. For example, well, the statute generally is 10 years, so some people have, and it's 10 years from the date that the return was filed. So you have to find out when the return was filed and when it was actually the taxes were actually hit the system. So it's a few weeks after it was filed, but that date is the beginning of the running of the statute. If you filed on time, let's say, or within the time frame, you can kind of figure from that time. In other words, a 2011 return, the statute, you file the year after, you file a year later. So you have to do a little calculating, but. And then I usually, as a matter of fact, I found exactly what the collection date is. I can get the transcripts and get all that and run and figure out exactly what the collection statute expiration dates are. But it's 10 years. So if you've already been it's been 3 or 4 or 5 years already, you may only have 4 or 5 years to stay. If you can stay in uncollectible status for another 5 years, then your taxes are going to go away by virtue of the statute. And I mean, it does happen. It happens a lot. So but it's not the most, it doesn't happen for most people, but it does happen a lot. And so the next method is a method that's the next two methods are installment agreements, and that's what most people use. The next video is about installment agreements, partial pay installment agreements, and standard installment agreements. If you have any questions, you can call me at 941-723-9106. An installment agreement may be your best option. In an installment agreement, you would be making equal monthly payments. The payments would be based on your ability to pay, and that ability to pay would be determined by the calculations that are drawn from the paperwork that you fill out, the forms that you fill out, and the documentation that's sent in with the forms to verify the numbers on the form. So there is a bit of a process to put it together. You can think of the form that you send in sort of like, it's not exactly like a form that you would fill out at the bank, for example, to get a loan. The reason it's not exactly like that is because they go into more detail and ask some other questions that you're not asked on a typical loan application. But I just use that as an example to help you understand what I'm talking about when I'm talking about sending in them or filling out forms. The entries on the form have to be supported. This is true with all of these agreements that you get. The documentation that supports these, there are certain things that they ask, and they do this for all of them. They're all done essentially the same way in terms of determining what you can do and what they can do with you. So one of the things that's required as well in all of these kinds of agreements with the IRS, all of your tax returns have to be filed going back. And I do like to caution people about refunds when I talk to them about installment agreements, because once you set one of these up, remember you're paying every month an amount of money which pretty much sucks up all of your disposable income that month. So you're just left with enough money to live on, and maybe a little bit of money for recreation expense and that sort of thing. But it depends on how your agreement it works. But you're paying this money out to pay your taxes every month. And let's say at the end of the year you get a refund on, let's say you're a wage earner, you get a W-2 and they've been withholding taxes all year, and they've withheld, let's just say for this example, $1,000 more than you actually owe that year. And so the taxpayers, a lot of times, they're expecting the government to send them a refund. Well, if you're in an installment agreement or in uncollectible status, or have an offering compromise, while you're still in that process, they're not going to send you the refund. They're going to take that money and apply it to taxes that you owe. So that's why you need to tweak. You need to calculate ahead of time, and you need to do this on an ongoing basis during the year, because people's incomes change. And the way to do it is you do what I call a dummy tax return. In other words, take your tax return from the current year, put current year numbers on it, and figure it out. I do this. This is what I do for people when we set them up. We talk about this, and going along, you need to check that occasionally to be sure, because that's just money that you're paying that you don't have to pay. And installment agreements are done more than any other, basic installment agreements are done more than any other method for resolving back tax debt.